Ik heb al zoveel van die man geleerd en ik dacht bij mezelf, jullie moeten die leren kennen. En daarom het woord aan Alasdair Macleod. Put your hands together.
Thanks very much. Thank you very much indeed. It's really lovely to be here, I must say. And thank goodness the weather is holding up. The weather is holding up rather than not what I'm doing with the microphone. I've been to many functions where I've been asked to speak after lunch, and I think I draw the short straw because amongst speakers, the post-lunch slot is known as the graveyard slot because everybody falls asleep. So my task is to try and make it interesting enough so that you stay awake and enjoy it. I'm afraid the topic I'm going to talk about is interesting but not that enjoyable. I want to start by defining the difference between money and credit. This is very, very important, which will become apparent as I progress. I think it was John Pierpont Morgan who in evidence to Congress in 1912 said gold is money and all else is credit. Now what did he mean? What he meant was that gold has no counterparty risk. It is internationally accepted as money, as a medium of exchange if you like, but it is credit which actually everything else, including currencies, even if a currency is tied to gold, it is still credit. Also, we know that bank deposits are credit. Now, you define credit, and this is why it's different from gold, as being the counterpart of debt. For every credit, there is a debt or an obligation to pay that credit. As soon as you appreciate that, you really do appreciate the difference between credit and money, proper money, which is gold. Now, this is a definition that goes back to Roman times. The Romans first introduced laws in about 450 BC with the 12 tables. And these 12 tables laid down various standards of behavior and penalties for not adhering to that behavior. About 1,000 years after that time, running up to Justinian's Pandects, which again were about 530 AD, jurors took those 12 tables and came up with rulings. Now, in our subject, the things that matter are what is money, and that was determined in the 12 tables very, very clearly as metallic. And in fact, the first form of money was the ice, which was about 2/3 of a kilo of bronze. Totally impractical, but I mean, given that there was no money before that, you could see that this was quite an innovation. That evolved into the purity of gold, silver, and copper as the principal forms of money. Now, that's still with us today. Why? For the very simple reason that Roman law is the basis of law of all the successor nations that came out of the Roman Empire. And that's all of us. And then we went and colonized the world. And so all those countries in their common law have gold as money, silver as money, copper as money. And indeed, it was only fairly recently, in relative terms anyway, that silver was dropped out of coinage, copper was dropped out of coinage, and we've gone on to imitations, if you like. So that basis of common law is still with us. And I would defy anyone to find modern law that actually denies that. Not only denies it, but rules that gold, silver and copper are no longer money. So what is the function of money with respect to credit? Well, what money does is it gives credit its value. And it gives credit its value because you should be able to exchange your credit for money, which is gold. And this was the basis of gold standards. And it gave us enormous stability, economic stability. It was the basis of progress in Europe, particularly in the 19th century. So this is a subject which we've now moved away from. Gradually, central banks moved away from allowing us to exchange our credit for gold, going back to the Americans in 1933, they then said, no, we no longer accept that the public can do this, and furthermore, the public has to submit their gold and their notes exchangeable for gold to the Treasury when they would be compensated in effectively fiat currency. Then there was a post-war arrangement, which was Bretton Woods. Now, under Bretton Woods, our central banks could exchange dollars for gold. And it was limited to just those few central banks. And of course, that led to a run eventually on America's gold reserves. And that was the end of the Bretton Woods system in 1971. And ever since then, gold has been driven out of the system, not legally, not by changing the law, but by propaganda. The Americans keep on telling us that gold is now a pet rock. It is no longer part of the monetary system. But this is just propaganda. Now, the test in this is the survivability of credit. If you look at what's happened to credit from the time when Bretton Woods ended, you will see that measured in dollars, gold measured in dollars, dollars have lost roughly 98.5% of their purchasing power. That, if you like, is a reciprocal of a price that's gone from $35 up to currently $2,400. It represents not an increase in the value of gold, but a decrease in the value of dollars. And we can say the same for all of our currencies. This is an ongoing process. Now, having lost, in the case of sterling, we've lost over 99%. I'll give you an example. The British sovereign, for example, was originally exchangeable at the Bank of England. One sovereign, £1. Do you know what a sovereign is nowadays? £450 each. In other words, the pound has lost 1/450th of its value, measured in real money, since the First World War. We don't notice this because we think that actually credit, which is currency is credit. And if you think I'm wrong in this, I know economists who say that, no, currency isn't credit. Of course it is. Why? Because of that counterparty risk test. If you look at the balance sheet of a central bank, this balance sheet says quite clearly that the notes out in issue, just the same as what are marked as commercial bank reserves, are a liability of the central bank. Of course, we assume that the central bank isn't going to renege on its obligations to us. But I would argue that these current conditions, economic conditions, with the increase in government debt to GDP in America, for example, at 130%, and getting worse. It doesn't matter who gets elected. The one thing we do know is that government deficits are going to increase and probably increase further, if only because the cost of the debt is rising faster than they could possibly chop back their spending. So this is a situation where it begins to look as if credit is going to lose its value more rapidly against real money than it has in the past. I should add, talking about Roman law, they also defined credit. And credit, as far as they were concerned, was an obligation, as I've just described it. It is not money. It is distinct from money. And the point about the obligation is that the obligation, if that obligation loses its credibility, then obviously it affects the value of the credit. The whole point about it was that various jurors then decided that actually credit is an asset. It is part of someone's wealth. And the reason it's part of someone's wealth is because you can transfer it without having to refer to the debtor, the original debtor. And of course, this is the basis of bond markets. If you think about it, government issues debt to someone. You've got subscribers for the debt, and then the subscriber of the debt is free to sell that obligation on, that debt, to someone else. In other words, it has value. Credit doesn't just stop there either. It goes considerably further. I mean, what is the status of equities, for example? Well, equities is another form of credit. I mean, you would think not. You think you possess part of a company. No, you don't. What you have is an obligation for the company to deliver an income stream to you, or at least accumulate an income stream as part of your entitlement, your share, if you like, the entitlement in the company. It's credit, just the same as ownership of government debt is, or any other debt for that matter. But it's got worse than that recently, because with all the sort of centralization of securities and what they call dematerialization, you don't have a certificate representing your shareholding. No, you have, if you like, an entitlement, a separate entitlement. The ownership of the share certificate, which again, as I said, is credit, is actually owned by a central counterparty. For example, I mean, you've got the Euroclear in Europe, you've got the DTCC in America. They actually own the share certificates, which are a debt obligation to them, and they then pass that obligation on to you. You are reading them for that value. So you got it twice over. And what do they pay you in? Well, they pay you in a bank deposit. If you sell your obligation, your interest in a company to someone else, you're going to get paid in, again, credit. The whole world works on credit. Money never circulates. We never go out and buy things with physical gold, except in extremis, perhaps. I'm not saying you can't do it. It's just you don't do it. So that is the background to it. Now, we have this situation today whereby this credit is getting riskier and riskier. If you look at government debt, we'll start with the US government. The US government at the moment is running deficits which have accumulated to the point where their debt to GDP is roughly 130%. Now, what that means is that they're injecting new money, if you like, new credit into the economy, which is reducing the purchasing power of the existing credit in the economy. Now, what this does is it pushes up GDP, and you think nominal GDP is growing. But actually all that's growing is the amount of credit which the government is injecting into the economy. Now that credit is matched, if you like, by the issue of debt, which again, as I said, is an obligation of the government to the purchasers of that debt. And this is going at an accelerating rate. Now, a point which very few people realize is that interest rates are set by the relationship of the expansion of that credit and the demand for it. In the case of the US, what we see is the two largest foreign holders of US debt are actually reducing their involvement in that debt. So what does that do to the price, if you like, the interest rate, the rate at which the Americans will borrow? Well, the answer is that assuming nothing else changes, then that's going to drive up bond yields. In other words, drive down the value of existing government debt. Not many people seem to understand this. It's a supply and demand situation which applies to credit in exactly the same way as it applies to food or general purchases, the supply of something which might be in short supply. What happens? The price goes up. Of course it does. The same happens with debt. So few people understand this. So this is creating a crisis because the Americans raised interest rates to try and control inflation. Well, what's inflation? Inflation actually is loss of purchasing power of the circulating medium. So they've raised interest rates, and that has created all sorts of problems because suddenly lots of people who planned their business models on interest rates remaining at close to zero, which they had for a long time, suddenly find they're paying 5%, 6%, 7%. I think it's 7% on mortgages, for example. Whoops, this is not good news. So where do we go from here? Well, if interest rates rise from here because of the problem of people tending on the margin to sell government debt rather than buy it, then this squeeze, if you like, is going to get worse. Now, let's look at it from the commercial bank's point of view. The commercial banks have lent a lot of money to what we would call zombie enterprises, companies which basically have taken on debt not for productive reasons, but because the availability was there. They're drowning in debt. Now, that's fine so long as interest rates remain low. But when they have risen from the zero bound up to 5.5%, which is approximately what's happened in America, and that's affected everybody else, suddenly these companies have big, big problems. And we also see this privately with our mortgages. Mortgage rates have risen. How can we afford such high mortgage rates when we have been suckered into property with mortgage rates which are ultra low? And in fact, in Denmark, I think they even went negative at one stage. I mean, it's just incredible. A mortgage rate which is negative. We should be so lucky. Anyway, that drove property prices up, and people had to pay huge, huge prices, only financed by borrowing huge, huge amounts of money at these low interest rates. That has now changed. So you can see from a commercial bank's point of view that a lot of their loans are going to start going sour. So what business does a bank do? A bank is a dealer in credit. It will lend you money, in other words, your deposit account, at zero or not much above. And at the same time, it will create credit for a business or whatever it might be at, say, 10%, maybe 8%, or if it's a really prime borrower, something like 5%. They're making that turn. That is their business. Now what's happening is that the people that they've loaned money to can't pay it back and are going bust. That's the problem. I mean, in our country, in England, we've got a very good example. Private equity bought into Thames Water. Now, Thames Water as a business model is absolutely ideal for private equity because you've got a regulator who will tell you how much money you can pay in dividends, what sort of return you can make, how much investment you've got to make in your infrastructure and all the rest of it. It is effectively an income which is guaranteed by a government regulator. And roughly the rate of return on capital is something like 8%. Okay, you're a private equity business. You could go along to a bank and you can leverage that up, say 5 times, by borrowing from the bank. The bank has got a lot of respect for you because you're a big, big, big wheel in the finance industry. You have been a big customer. The bank will bend over backwards to keep your business. So what happens is that you suddenly find that Thames Water has got debt, which is giving the private equity capitalist something like a 40% return on his equity because it's all leveraged up. And the company suddenly is bust. Why? Because interest rates have risen and they can't refinance it without driving the company into liquidation. And this is happening not just with Thames Water. The whole of the private equity industry has got exactly the same problem. Look at the commercial real estate situation in America. The banks there have lost roughly, I mean, the estimates are they've lost more than half their shareholders' capital on commercial real estate. Nobody wants commercial real estate anymore. The cost of financing these tower blocks has shot up, and at the same time, people are working from home. They're empty. And of course, it's absolutely killed the value of these properties. So this is a banking problem. What do the banks do? Now, you've got a good idea. You want to go and evolve your business, and you're going to need £1 million to do it. Or alternatively, you might just want to keep your overdraft facility. So you go and talk to the bank. And the bank says, sorry, no. You lean on the bank as much as you can. You plead, you go down on your knees. And then the bank says, well, I tell you what, we'll lend you half of what you want, but the interest rate is going to go up. Instead of you paying 6%, 7%, it's going to be 12%. And you've got no option to go for it. But the bank has no option because it's trying to duck all the bad debts which are suddenly arising from the rise in interest rates and all the financing that has been irresponsibly entered into by zombie borrowers, by people who have been forced to borrow but at higher interest rates because they need to have a roof over their head and there's no letting market. They can't find it. They can't go and let a property. They've got to go and actually buy one. They're forced into the mortgage market. In other words, the whole economy suddenly is drifting into problems. And what is happening under this is that interest rates are rising because there is a risk premium as far as the banks are concerned. They're already over-leveraged, incidentally. And this is particularly true of Japan, where the GSIBs, the global systemically important banks, are 20 times leveraged, assets to equity. Eurozone banks, some of them are close to 20 times leveraged, assets to equity. What that means is that if they make a loss, the effect on the equity is 20 times what it is on their assets. Their equity gets wiped out very, very quickly in these developing problems. The American banking system has an historically high average level of assets to equity at around about 13.5 to 14 times. Bearing in mind that before the last crisis, in around about 2005, it was about 8 times. So that you can see that these banks are now in a perilous position. So keep in mind, what is the value of credit as a whole? Is it still worth, if you like, what it was in terms of risk premium, opportunity, whatever, as it was in the past? The answer is this is disappearing quite rapidly. And this is why it appears that gold is rising, but it's not actually rising. What's happening is the value of credit is going down. If you go and talk to the People's Bank of China, you'll be told that the People's Bank of China have been buying gold. Well, that's not quite the story. Actually, what they've been doing is they've been getting out of dollar credit. They realize the risks to the dollar. They do not want dollars, so they're getting out of dollars. And it's not just gold, silver. They've been stockpiling things like copper, which Simon was referring to earlier. And we know why now, particularly, don't we? I'm sure they've been stockpiling other things like lithium. They've stopped exporting rare earth metals. They've also been buying grains. Why? Because they want to get out of credit, dollar credit. Now, I know part of this is de-dollarization. These two, Russia and China in partnership, basically running the whole of Asia, with the exception of a few pockets in Southeast Asia, but including now what we call the Middle East, they call West Asia. Also the Global South. They are really extending their tentacles. They're running the whole world, and they don't want the dollar to be involved, so they are de-dollarizing. But they realize that they mustn't create a crisis. So we're in a situation where, you've got changes in policies. The Chinese don't want to really upset the apple cart. But the one thing we could see is that the value of credit, dollar credit, is going down. And it's a very important point to recognize that that is what is happening, not gold going up. There is another story on that. I'll come to that later on. I hope you remind me if I don't. I now want to turn my attention to the situation in Europe. The ECB reluctantly started raising interest rates at the same time as the Fed did, but they're always one step behind. They're now one step ahead of them, trying to reduce it. But anyway, the point being that the ECB, the Euro system, comprised of the national central banks and the ECB, virtually all have enormous losses on their balance sheets due to quantitative easing. Quantitative easing, basically, I would define it this way. It is a mechanism whereby a central bank pays the maximum possible price for government debt. Now, that's not how they'll put it, but that's effectively what it is. So the ECB has now got huge, great losses on its balance sheet. So has the Bundesbank. So has the Bank of France. So has the Banca d'Italia. They've all got enormous losses on their balance sheets. Now, I know how to recapitalize a central bank. It's actually very, very easy. On one side of the balance sheet, you create a loan. On the other side of the balance sheet, instead of a matching deposit, because remember, it's always got a balance, both sides have got a balance, the condition of creating a loan is that you create a deposit at the same time on the other side of your balance sheet. But what you do when you're recapitalizing a central bank is instead of calling it a deposit, you call that liability equity. So that you've recapitalized yourself. Magic. Easy. Easy peasy. Now, work out in your own minds how the Euro system, comprised of the ECB and national central banks, are going to manage this. The ECB is owned by what they call key holders. In other words, the equity is actually held by all the national central banks in the Euro system in different proportions. Now, let's look at it from the point of view of the lawmakers in Germany. The Bundesbank goes to the parliament and says, we need to recapitalize. And at the same time, not only do we need to recapitalize ourselves, we probably need another 2.5 trillion or something like that euros, but also we need to recapitalize our share of the ECB. Now you can see the lawmakers, and they're always ignorant, as far as bankers are concerned, they don't know what they're doing. They've got a problem explaining this one to the lawmakers. The lawmakers say, hold on a minute, you're owed over 1 trillion euros through the Target 2 system. Why can't you use that? Oh my God. Oh, how could we explain to these people? You could see that recapitalizing the Euro system is going to be virtually impossible because this debate in Germany is going to be echoed in every other country which needs to have parliamentary approval to approve the recapitalization of their own central banks and also their share of the ECB. It is a very cumbersome operation at the very, very least and takes a lot of time. Now, I would argue that if we have a credit crisis, the one thing the ECB and the Euro system as a whole has is not time. It does not have time. Solutions have to be implemented immediately. So I would say, if I was asked to come up with a firm opinion, that the Euro system will not last the next crisis. This is a real problem, and I think you should be aware of it. Now, what does that mean for all of us here? Well, I got the same problem, but with sterling, so we'll pass on that one. But for all of us here, it is quite clear that the message is get the hell out of credit. Get out of credit. Get into real money. Now let's talk about Japan. Japan is another country where there is massive leverage in the banking system. Now go back to my definition. What is a bank? A bank is a dealer in credit. When the Bank of Japan reduced interest rates into negative territory, just the same as ECB, idiots, negative territory for interest rates. Anyway, what happened is that it compressed the lending margins of the banking system so much that the only way they could maintain profits at the bottom line was to increase their leverage. And the result is that virtually all the major Japanese banks, the G-SIBs, the global systemically important banks who spread their risk around the world as counterparties within the global banking system, they are all leveraged 20 times assets, balance sheet assets to equity. This is a real problem now that bond yields are rising, which basically means that bond values fall. Now, the strains began to be illustrated when the Norin Chicken Bank, which is a farmers and fisheries cooperative banking system, announced that it had unexpected losses of $69 billion equivalent on its portfolio of foreign bond investments. So these were investments in US treasuries, agency bonds as well, I guess, and also in Euro system or the Eurozone bonds, and I think principally these were French and Italian bonds. I mean, the reason for investing in these things is that they could only get 0.5% out of a 10-year Japanese government bond, whereas they could get 3%, say, out of a French bond. So what do? You go buy the French bond because on your balance sheet it looks better. Not only that, but you leverage the position. By leveraging the position, you can basically ensure that your profits at the bottom line for shareholders are continuing to grow. That's what they were doing. But now that that music has stopped, Norinchukin Bank suddenly has huge, great losses on its balance sheet. We're not talking about a big bank. We're talking about a relatively small bank losing $69 billion of value on its portfolio. It said it's got to liquidate this portfolio. And I looked at the announcement and I thought, these guys are crazy, absolutely crazy. What they were looking to do was to sell their low-yielding treasuries and get into higher-yielding corporate debt. Oh, my goodness me. They just don't know what they're doing. And I'm afraid this is quite common within the banking system. Anyway, we now have another problem. In the last 2 weeks, the yen started bouncing against the dollar. It had fallen in the last, since the beginning of January 2022, it's fallen from 100 to the dollar to 162 to the dollar. The number is the other way up. So a higher number for the yen basically is a lower value of the yen. Okay. Now, recently it's bounced to about 152. But what this has done is it's magnified the losses of all these banks and pension funds and insurance companies in Japan on their US dollar investments. So what happens is that they start selling their own stocks. The Japanese stock market, I think it was on Wednesday, fell 4% measured by the Nikkei 225, which is the main index. 4% in one day. It's lost about 11% over the last 10 trading sessions. Now, this came at a very awkward time for the US stock market because those tech stocks, the big seven, the sort of Metas and so on, they'd started losing momentum and started earnings reports last week, which in many cases were disappointing. So they've started falling. This looks like the beginning of a rout because you have got the speculators in the US stock market beginning to make losses on these things which have been absolutely wonderful, and they're having to liquidate positions in futures markets as well, futures and options markets. And at the same time, the Japanese are turning sellers of their US investments. To give you an idea of the scale of this problem as a whole, not just Japan, but everybody, the value of financial investments in America held by foreigners, according to the US Treasury, is in the order of $32 trillion. That is more than the US GDP, which is roughly 28 trillion. It is almost the same amount of money as the US government debt, which is knocking on 35 trillion. Would you want to hold dollars under these circumstances? I would suggest a rational person would not. So again, get out of credit. So we're looking at a situation where we've got the whole of the central banking system needing recapitalization because of the losses from QE. I've described the Bank of Japan situation. No, it was the ECB situation, but the Bank of Japan at one stage, and I think it's probably still generally true, the losses that the Bank of Japan has made on its portfolio, bearing in mind it owns nearly 60% of all government debt. Its losses, I calculate, to be roughly 40,000 times its equity capital. Now, if we get a problem in the commercial banking system, like failure of counterparties, in the derivatives market, let's sort of just throw an idea out. We expect the central banks to turn round and underwrite the commercial banking system. So if you're going to underwrite a commercial banking system where you yourself are already bust, how are you going to do it? Well, I would say with quite a lot of difficulty. So from our point of view, what do you want to do? Get the hell out of credit. It could be that this recent development in the Japanese, if you like, the Japanese investment scene, whereby they're being forced out of their investments in America, also in Europe. And I noted that two of the biggest fallers last week were the French stock market and also the Italian stock market in particular. These are areas where we know the Japanese institutions have been active. Then it just seems to me that this could be the beginning of a crash. Now, I hope I'm wrong. I'm not wishing this to happen. But it's very, very similar to the situation which led to the crisis in 1987. I remember that very, very well. So what do you want to do? Get out of credit. Because that credit is not going to be honoured at the end of the day. The best outcome you have got with credit is that the decline will be managed and you will have time to gradually ease your way out of it. But when I look at the problems that Western credit capital markets currently face, I would not reckon that I got very much time to get out of credit. Now let's talk for a bit about geopolitics. This is a very interesting topic because on the one hand, we have us. We have the NATO alliance. We have got America. America, the world's policeman, looking after all our interests for us, ensuring a nice, peaceful world. Well, it's all right as long as you're not in the Middle East, but, you know, who cares about them? Well, we do now because they're all knocking on our door. But anyway, the Americans don't care. And the thing that is absolutely amazing is that in this NATO partnership, we don't blame the Americans for all these sort of mass immigration problems we have. I suppose partly because we were party to it. But make no mistake, the reason that we have got, now who are they? Let's see. We've got Iraqis, we have got Africans now that once Gaddafi was knocked out, they're all coming into Italy. We've got, now let me see, Afghans, what happened there? Yeah, Biden walked out of there. I remember seeing pictures of people hanging onto the undercraft of planes, you know, desperate to get out. Syria, another one. Iraq, did I say Iraq? You know, and these are the guys who are trying to get into Europe now. It's creating a huge, great problem for us. Who is responsible? We were, because we went along with America's desire to, if you like, get retribution for 9/11 originally. We've gone along with that and we've paid the price. There is another half of the world which isn't in this deal at all. And this is Asia. This is being run jointly, in effect, managed, benignly, I think, by China and Russia. And not only have you got the Shanghai Cooperation Organization, which basically encompasses virtually all, in terms of members, associates, and dialogue partners, which are the three categories, encompasses basically all of Asia, with the exception of some pockets in Southeast Asia, because it now includes India, incidentally. And then you've got BRICS as well. BRICS is comprised of now 10 nations with about 70 looking possibly to join. And interestingly, the BRICS organization is looking at a proposal called the unit, which is a new trade settlement currency. Now, I looked at the construction of that, and I still think they've got an awful lot of work to do. I actually wrote a paper as to how it should be done, and they've gone part of the way along my route. But I suspect for political reasons, they've still included paper currencies unattached to gold, which is absolutely crazy. They just should have it backed by gold. Anyway, the point is that there's another world out there. Now, while we sink into a situation where our credit becomes completely valueless, the majority of the world by population is already moving away from us, and they have built the gold reserves official and unofficial, in order to pin the value of their currencies in the event that our currencies go down the Swanee. So this means that there will be life after credit's death. But meantime, what do? Just get the hell out of credit. And that is why gold appears to be rising. Now, just one final note on this, and that is, look at the savings rate in China. The Chinese population, according to the numbers, and I know these are derived statistics, but they are nonetheless, I think, not too far from reality. The Chinese households save, on average, 35% of their income. 35% of their income. That is the equivalent of $6 trillion. Now, in the past, what they've done is they've put it into property. They buy apartments off plan. And these apartments, they never go and live in them. I mean, they just own them. And the value of those apartments has basically been maintained. That's fine. But last year, there began a property crisis. And nobody buys property anymore. None of these things are being bought off plan. So of that $6 trillion equivalent, none of it's going into property. Then you've got the stock market. Well, for the last 3 years, the Chinese stock market has been going down. It has bounced a bit this year so far, but certainly not enough to encourage Mrs. Wong or whoever the Japanese housewife is to go and invest in stocks. So what else? Well, what they have been doing is they have been adding to their bank accounts. They have been adding to their bank accounts something called CDs, certificates of deposit, which is something different from what we understand in our financial system. A Chinese certificate of deposit is basically a 2 or 3 year maturity deposit. In other words, you get paid an interest rate on the basis that you hold it for that period of time, which reflects a higher rate of interest than a cash withdrawal basis or a cash withdrawal deposit. That's where it's all been going. But there is another thing. I think it was earlier this year, it might have been late last year. The Chinese government instructed banks to offer gold accounts. Now, what this basically means is that if you have got, say, $75, so this is something for small savers, the equivalent of $75, 500 yuan, then you can open a gold account. Now, what this means is that your bank account will track the value of gold. So what does the bank do? Well, the bank has got this potential liability. It has to go into the market and buy gold. So just to summarize, we have the equivalent of $6 trillion with unattractive alternatives. And indeed, I noticed that the Chinese lowered their interest rates the other day, making bank accounts even less attractive. And that is increasingly being funneled into these gold accounts. I mean, they're also buying jewelry and all the rest of it, but, buy jewelry, you pay 20% sales tax. But this is very attractive. Where do they get their gold? Where do the banks get their gold to cover? Well, I suppose they're working a fractional reserve system, which means they don't necessarily cover it all, but they're certainly not going to go 20 to 1 like our lot. No way. They will buy gold. And where is it coming from? It's coming from Western markets. And that is why there is a shortage of physical gold in London and in New York. And the interesting thing is that while I say it's not gold going up, it's credit going down, this is an additional factor which actually could drive gold and silver considerably higher, irrespective of any valuation which you would separate out, which is due to our wonderful credit system declining. So I think with that's probably quite a lot of information for you. I'm sorry, I hope I haven't overloaded your enormous brains, but I think you should consider yourself now better informed than the vast majority of people about money, credit, and their future. Thank you very much. Questions?
We're going to do some questions first,
Yeah,
and then
Whatever way round you want.
Yes, thanks a lot. Great talk, and I learned a lot, surely. Still, I understand the relative value of credit, but then I'm thinking about the relative value of gold, because gold is only what we make of it. If I'm in the middle of the jungle, I'd rather have a few liters of drinking water than a kilo of gold. So why is gold so important? Because gold, in the end, doesn't do anything either.
Yeah, I mean, what you're saying is the old story, which I think was it someone like Schumpeter came out with originally, and that is that water in a desert is considerably more valuable to a thirsty person than a bucket full of diamonds. I mean, yeah, that's absolutely right. But I'll tell you another story. When you get Navy SEALs or SAS men parachuted into the middle of Asia, let's say, the one thing they will have in their pockets are gold coins or silver coins, because that will be accepted by the nomads, by the ignorant locals who don't know anything about modern money, credit and so on and so forth, won't accept your banknotes. They will accept that. So I think that would counter your story with understanding that gold is understood to be money virtually everywhere. I'll tell you something else. At the same time, when the Romans formulated the 12 tables, it was at about that time that Confucius was philosophizing in China. It was about the same time, indeed, as Socrates, Aristotle, that lot, that great Greek philosophical revolution was taking place. And all these places accepted that gold, silver, and copper are money. This is something not just forced on us, if you like, by Roman law, is also in accordance with everybody's understanding of where value lies in terms of something that you can use to exchange for goods.
Thanks.
Another question?
Thank you. Where do central bank digital currencies fit into this picture?
That is a very, very interesting point. I'll start with a story. At the time of the French Revolution, the reason for the French Revolution is probably not what you've been told in your history classes, but it was actually the collapse of the currency, which was the assignat. The assignat collapsed, not totally at that stage, but it certainly was impoverishing an awful lot of discontented people. Storm the Bastille. What do you do when that happens? And when our credit goes down the swallow, well, I hope not. But you can see the point. What then happened was that the Revolutionary Council decided to replace the assignat with a new currency, the mandat territoriaux. Excuse my French pronunciation. And within 6 months, that was gone too. And I look at this proposal for central bank digital currencies, and I remember the history of one fiat currency trying to replace another one. And I think people just don't learn. They really don't. I mean, when you look at the statements that came out of the Bank of International Settlements, Augustin Carsten, he was saying, well, it'll allow us to manage the economy. In other words, they will direct this new credit where they want, not where it is demanded by entrepreneurial activity, saying to a bank, I got this idea, but what I need to do is have a facility. No, it's the government turning around and saying, we need to promote this activity. They've got no skin in the game. They don't know what they're doing. I mean, this is going to be the most inflationary thing we've ever seen. Credit. Get the hell out of credit. It's just reinforcing the argument.
Thank you.
Yeah, maybe a stupid question, but what does it mean for the normal people? You have someone who doesn't own a house and have to pay every month and don't has enough money. You have a young family who just bought a house. Yeah, they can get out of credit. What does it mean for the concrete people?
Yeah, it's extremely worrying. It really is very, very worrying. I think the best thing I can suggest is, if you really want to know the answer to that, examine what happened in the Weimar inflation between 20 and 23. It wiped out the middle classes, the professional classes, but the ordinary people under it had an even worse time. What I'm saying, the collapse of credit is horrendous. It really is. It is awful. The values of property, for example, will go down. You would think, I mean, people tell me that, well, you know, the way to get out of credit is to own a house. But the problem with that is that how do you value the property? You value it in credit. And the celebrated Austrian author Stefan Zweig, wrote in his memoirs about the German hyperinflation, and he said that in 1923 you could have bought a house in Berlin, 6 bedrooms, swanky part of the city, for $100. It may have been a few trillion, I don't know, trillions of paper marks, but the reality was only $100. What was $100? Well, at $20.67 to the ounce, it was slightly less than 5 ounces. That's what happens to asset values. The idea that you can escape this by buying something which isn't credit and actually own it yourself is extremely limited. All that will do is it will give you a roof over your own head. But if you reckon that this is an escape from credit, then it's not an escape from credit, because the value of that house will still depend on the availability of credit. But I think the point you raise is absolutely right. It is the people who are going to get hurt very, very badly by this development. And this indeed is why I've set up my own Substack channel, because I want to educate people about this problem. It's not that I'm promoting gold. I'm no longer in the business of promoting gold or promoting anything. I just want to educate people. And so my Substack is actually growing quite rapidly, I'm glad to say, because I have identified there are lots of people asking the sort of question that you asked and wanting some guidance as to how to steer through a situation which to increasing numbers of people, they see it being, you know, risk. There's risk in everything. They see the fragility of the whole system. They are worried about the whole system. They see, in spite of all these mollifying words about how the economy is growing, no, it's not. You know, my neighbours are out of work, or this business, local business, can't borrow any money and it's got to close. That is the reality on the high street, Main Street, if you like, as opposed to Wall Street. Wall Street's partying like nothing. Nothing is going to stop this party. But the reality on the ground is not good. Credit is going to collapse, and it's going to get worse for ordinary people. And that's why I set up my Substack, to try and educate people as to exactly how this is progressing and why it is a danger. And if they keep abreast of the developments, then hopefully they will know how to alleviate the problems as much as possible, not just for themselves, but also for their families. Because I can tell you one thing, you might understand get out of credit, but when you tell members of your family why you should get out of credit, they won't believe you. They really won't. So we've got to think about that too. Another question? Over there.
Hello, yes. I believe all debts are already prepaid. House Joint Rule 192. And if you go back a long time in history, we've been rigged. The City of London, Washington, D.C., and the Vatican has been playing long time a mind game with us through the Strawman, where we were born and our parents in unawareness declared us, and a birth certificate started, and our double role as a person starts, while we're all sitting here as living men and women. And through equity law, equity courts, I find a solution through becoming a private banker. If you're in register, if you get out of the system that they are playing with you, and you, for example, apply for a EIN number, employer identification number, you can become your own private banker. And through some re-education of your own knowledge about how the banking system works, grammar, syntax, forms through the IRS.
Can I stop you there? Sorry, can I stop you there?
Yeah.
Nothing you have said convinces me that you're getting out of credit. When you say that all debts are paid, no, they're not. The reason that credit exists is because debt is on the other side of someone's balance sheet. Believe you me, with all the debt around, the credit exactly balances it. If that debt is likely to fail, then so is the credit. For example, in the Depression, the Great Depression in America, money supply contracted by 40%. Why did it contract 40%? I mean, the economists got this horribly wrong. The answer is extremely simple. And that is roughly 40% of the banking system went bust. In other words, they reneged on their obligations to their depositors. That is why it contracted. So any idea of setting up some alternative banking, whatever, private banking, forget it.
Trust law.
Sorry?
To put it in trust law.
You're still in credit. You've got to get out of credit. It's as simple as that. Putting things in, you're just putting credit into a trust. That doesn't save you.
No, but you bring it in equity. So it's
Equity is another form of credit. In other words, it is a debt. It's an obligation, if you like, from someone who has taken that money off you, that credit off you, to repay it in an income stream, or at least to accumulate it on your behalf to your account. This is all credit. Everything is credit. So you cannot escape it.
Everything can be a trust too.
Even in a trust, it's still credit. You know, you can have a trust which owns government bonds, whatever. It's all credit.
But
You're
we are
gonna
the
lose
creditors, and this is the aspect that we forgot about, no?
No.
Because they treat us like debtors, like useless eaters, like sheeple, and that's why we lose the grit to claim our responsibility and to be the creditors.
Debt equals credit. Two sides of a balance sheet. If the debt is not repaid, the credit is valueless. It's as simple as that. Can we have another question? Yes, this lady here.
If you buy woods or ground, that's also a good investment ground.
Yeah, well,
terrains, places, a place of the desert. If climate change, it can become a tropical forest, maybe. You never know.
Well, I think dream on. I mean, again, going back to the great inflation in Germany, the inflation kings, the people who knew how to manipulate inflation. I mean, the equivalent of our today multi-billionaires. At that time, they were accumulating, they were buying whole estates. Now, that's fine, yeah, okay, what you say makes sense, but what was the value?
Long-term investment.
Well, hold on a second. The value measured in the paper marks might have gone up substantially, but measured in gold, it went down substantially. Now, I'm not saying that you shouldn't buy an estate, because what you can do is you can feed yourself off it. You know, and as you say, if you go through, you know, the whole cycle of the destruction of credit, we will come out at the other end at some stage, and the value will return in whatever credit replaces the current system in the future. I mean, I would quite agree with that. It would also be true of houses. But the idea that you can escape the collapse of credit and retain value in property, whether it's land or housing or whatever, because it's measured in credit and credit collapses, there is no value for it. So you've got to see yourself through that period. But I would say the one thing, and that is land makes a lot more sense than owning houses. Any other question? There's one here?
Wait.
Hold on.
Maybe a simple one. When I understood you quite well, then if you invest in people and in collaboration between groups of people, then you have golden hands for the future.
Well, yeah. I mean, I think in the broadest sense, we are communities of people. We rely on other people to produce things for us, and that is a cooperative thing, the division of labour, if you like. So, yes, but going through this credit crisis, if I'm right, I mean, I may well be wrong, but I can't see how I am wrong, which I would say, I suppose, then I think the immediate problem is that the people who surround you are going to be in great, great difficulties because they don't know how to protect themselves. They can't even analyze the problem. The only people who analyze the problem to begin with are foreigners. Foreigners who own your currency, say, they decide they don't want it. But you're the last, as a user of the currency generally, the population that uses a currency is the last to understand that it's not prices going up, but the currency going down. So they're going to get caught. And I think anyone who protects himself must think about his surrounding community as well, because that is going to be very, very difficult. Another question? There's one here. Yeah.
I have two questions for you. We all know that it's going to collapse one way or another. So this is not new. But what about they're imposing us the digital centralized currency? Because they're working on it, we know it. So this is, how can we avoid this? Because if the central banks, the BIS and everything is imposing it on us, how can we avoid it? Because they have a lot of digital power. So it's a lot of people, they're using their credit cards without thinking already now. They're so used to it, this kind of digital stuff. This is my first question. And my second question is, the new gold could be the bitcoins. I know it's very speculative for the moment, but there are things going on in Singapore, that would make it eventually like a real currency. This is not yet the case, but it's coming, probably. So these are my two questions to you. How to avoid the digital centralized currency? And secondly, what do you think about an alternative to gold and land under the form of that the Bitcoin and some of these currencies become real money?
Okay, well, central bank digital currencies, the inflationary consequences of it is something I mentioned to a question from over there. Mm-hmm. I think it's going to take time to introduce central bank digital currencies. A small jurisdiction like Bahamas or somewhere like that can introduce it because it's not really a very, very big deal. But when you look at, say, the Fed, introducing it actually is not going to be easy. The reason is that it's going to put the existing commercial banking network's nose out of joint. And guess who subsidizes the election campaigns of Democrats and Republicans in America? More than anyone else, it's the big banks. I think a businessman a long time ago in America said a good congressman is one who's bought and stays bought. And that basically is the approach, if you like, to American politics. So I think it's quite difficult to see that it will ever be introduced in America. And if it's not introduced in America, then that makes it less likely it will be introduced anywhere else. I think in Britain, I can see that the planning that's required and all the rest of it will mean that there are committees for the next 5 to 10 years before it goes up before Parliament. So this is not something that's going to happen very quickly. And indeed, the Bank of England in its white paper decided to duck this issue as much as possible by saying, we won't distribute the CBDC, we will leave that to commercial banks. Because the whole idea of a CBDC is that we all have accounts at the central bank, ourselves as people and also the businesses. And we either get credit fed into our accounts or presumably if they don't like it, taken away from it. So you can see that the original intention was for the central bank to manage it. But the problem with a large jurisdiction is that, because of if you like, software failures and all the rest of it. All the testing has to be done to destruction. You've got committee meetings, you've got the whole thing, then you've got legislation to approve it. This is not going to happen for some time. So if we're around, I suggest you ask me the question in 5 years' time. Now, Bitcoin. This is a fascinating one. The legal position is that Bitcoin is not money. Of that, there is absolutely no doubt. People who support Bitcoin and the idea of it being money don't really accept this point. They think, oh, well, the whole world's going to collapse, so who gives a damn about the law, about what's money and what isn't? We will set what is money. That seems to be the general view amongst Bitcoin enthusiasts. When I look at the psychology of Bitcoin, I see people who have got out of dollars or whatever, not because they're getting out of dollars so much, but because they think, God, we're going to make a lot of money by buying Bitcoin. That is the driving motive, speculation. And you can see this in the price, which swings from what? Under $10,000 to over $70,000. Now, the people who support Bitcoin, I would venture to suggest, don't understand the relationship between money and credit. Look at it this way. If you're a businessman and you decide that you want to build a factory, the objective being that you're going to earn money out of that factory in the future by selling product. It's a project that probably takes 5, 10 years. In Europe, probably even longer. So, if, let us say, the credit is tied to Bitcoin, what is the value of that Bitcoin when it comes to your final product? Can you do the business calculation necessary to persuade a bank to give you the facility in terms of credit which you need for this business? You can't. It just doesn't work. And this is the whole point. People who are enthusiastic about Bitcoin actually don't realize that it's not Bitcoin that circulates if it was money, it's the credit on the back of it. And if it can't create, if stable value credit cannot be produced on the back of it, then it is completely useless. There is another factor which I was discussing with some people a little earlier. That is the legal position of money compared with the legal position of other property. It's not just money, but also fungible stuff, like food, for example. Now, let's assume that someone breaks into your house, steals your wallet, full of euros, you hope, or in this case, you hope not, and then goes and spends it. You have recourse against the thief. You do not have recourse against the shop which took your euros from the thief. In other words, if the thief is shown to be guilty or on a charge, you can't go along to the shop and say, hey, you know, that was my money, give it back to me. You cannot do that in law. If, on the other hand, someone walks in and steals a bit of your furniture or a painting on the wall and it disappears, and then some poor person, maybe going to an auction, buys this lovely painting, thinking that it is actually theirs when they buy it, and then you come along and say, no, that painting, it was my painting, and here's the proof. You reclaim that painting without any compensation to the hapless buyer. This is the difference between money in law, credit, money and credit, and also goods, if you like, which has a specific identity. Now, the reason this matters in the case of Bitcoin is because the blockchain gives every Bitcoin and every bit of Bitcoin an identity. Now, this has yet to be tested in law, but the way I see this going is quite simply that the authorities who look at Bitcoin don't like Bitcoin, and not only that, but Bitcoin have been used as often as not, your Bitcoin, previously owned by someone who, let's say, was involved in money laundering or the proceeds of crime. That means the authorities can come and reclaim that Bitcoin from you without compensation. So that's another reason it cannot work as money. Those two things, the creation of credit and also its legal status.
I believe we have time for one more question from the audience, if there is one. Let me hand you the mic, Christopher.
Yeah, thank you for a very interesting talk. I'm just curious about your viewpoint about the Great Taking by David Rogers Webb, because there's some things in there where he even claims property or things that have been bought can still be claimed back because of certain laws. I'm just curious if you've got any viewpoints about that book and his theory.
Yeah, well, it's another reason you should get out of credit. Yeah, I'll go into a little more detail than that bald answer. Basically, what the David Webb's Great Taking pointed out is that the dematerialization of financial securities, by which we mean you no longer have a certificate representing possession of shares, but you have it's on a ledger, if you like, and the ledger is run by a central counterparty like Euroclear, for example. So that technically what happens is that as far as the company is concerned, the investment, if you like, the company or whether it's a bond, as far as they're concerned, their shareholder is Euroclear, yeah, but then Euroclear has an obligation to you that if you want to sell the shares, they will honour the transfer from your name to the name of the buyer. Okay? Now, what this means is that in the event of a financial crisis, central counterparties like Euroclear, who are very thinly capitalized, particularly in relation to the enormous amount of financial investments which are on their books, if you get a counterparty failure, then Euroclear can't necessarily match it. But what they can do is take that ownership, if you like, of equity, in other words, the credit from the company in the form of equity, and use that as collateral to cover the financial situation which they need to fill because of counterparty failure. So that was the whole idea behind it. Now, David Webb's book was really warning us what this really means as far as we're all concerned. We don't own the shares. That's the whole point. All we get, in effect, is if you like, a computer entry being an entitlement. That's all. So you've actually got credit on credit. As my Jewish friends say, it's like pig on pork. You know, so I mean, I think that the problem is real, and you do have to understand this. So thank you very much indeed for raising it. Any other questions?
I thought it was a
We're
very
done.
good question, Christopher. I have one last small question of my own. I once heard you say there is no such thing as intrinsic value. Did you ever say that, Alasdair? And what did you mean by that in just a few sentences?
I did say that, and it is true. The reason it's true is the definition of intrinsic means that it comes from within itself. The only way you can value anything is in comparison with something else. You value, let us say, the wonderful stakes there. It's got a financial value. It's got a value in euros. It doesn't have an intrinsic value. Gold doesn't have an intrinsic value. Anybody who tries to tell you about intrinsic value basically doesn't understand that in order to value anything, you have to compare it with something else. That is the whole point. And that is why you cannot have intrinsic value.
Thank you. Thank you, Alasdair. The very last question goes to Paul, who brought you here and brought us together today. So thank you, Paul. Thank you, Alasdair.
Yeah, thanks a lot, Joachim, and lovely to see you again, Alasdair, after all these years. Because
Likewise.
we worked together 13 years ago, I believe, for Gold Money in London. And nice to see you after all these years. One quick thing, I interviewed David Rogers Webb for my own channel, Reinvent Money, about his book, about his documentary. So it's, I I think if you want to know more about his book and some of these questions I also had, and check out the interview. It's on reinvent.money, and there you can find interview with him, but also with people like John Mersheimer, Jeffrey Sachs, a lot of interesting people I talked to over the past few months. But David Webb is very interesting, and I believe he probably has a point, and we need to be very careful what we have in terms of paper assets. Reinvent money. It's reinvent.money. There you see all the interviews, including David Webb. My question to you, Alasdair, is you've been warning about a next euro crisis over the past few years. Could you walk us through the sequence of events that could lead up to this crisis? Like, how are we going to see this play out? What's going to be the trigger? Last time it was Greek finances out of whack that led to a fall of trust in Greek obligations, and then it basically rippled through the euro system. How are we going to see a euro crisis next, and how can we notice that, or what's going to happen to our finances in real time?
Well, pick any one from 2030, I don't know. There was a saying in the late 80s when stock markets crashed that a butterfly flapping its wings in the Brazilian jungle could create a hurricane out in the Atlantic. Your chaos theory. And the chaos, I think, is that we've got so many weak points, so many pressure points where we can have something that escalates. I mentioned earlier the situation with Japanese institutions selling US equities, selling down their own equity markets, all on the back of a bounce in the yen against the dollar, the yen-dollar rate. Now that could escalate. Now, quite simply, if that deteriorates into a 1987 style crash, I'm not ruling it out, I'm not ruling it in, I'm just saying there is actually a possibility. Then you've got to think in terms of, again, David Webb's analysis. I mean, we're looking at collateral here, the value of collateral. So you will find that bank positions are exposed as being, if you like, uncollateralized. And when it comes to the Euroclears of this world, they're going to have the same problem, that they're going to have counterparty failures. And they could well trigger the situation where they take what you think is your stock and lend it out in order to secure their finance. So that's one possibility. I mean, I'm also looking at central banks. I've mentioned central bank balance sheets are in a terrible condition. They're certainly in no condition to rescue commercial banks, which are over-leveraged at this point in time. You've got the whole of the derivative market. We're looking at, in terms of foreign exchange alone, the Bank of International Settlements reckoned that dollar obligations, which are always one side of the transaction, because that's the way it works, were around about $85 trillion, not recorded in the American financial system. That's just foreign exchange obligations. Forward deals, if you like. Because the way they work is that if you want to buy pounds, what happens is you sell your euros for dollars and then you sell the dollars for pounds. That's the way it works. So that is a problem. On top of that, you've got, obviously I mentioned the commercial banking system, over-leveraged at this point. And traditionally, whenever you get a banking crisis, it is because banks have become over-leveraged. And we are definitely at that point. So that's another one. You've got, looking at the euro system, you've got those target 2 imbalances. They represent something rather nasty, hidden in the woodwork. Let's not go into it, but, I'm sure there's a risk there. I think the principal risk, however, which I see is the debt trap, which the US government has got itself into. The more funding it's got to do in terms of its government debt. And remember, this government debt is very short term now. We're looking at an average maturity, I think, of around about 3 to 4 years. So it's getting rolled over quickly. We're talking about 35 trillion of debt and rising at the rate of over $1 trillion every 3 months. This is a serious problem. And it's happening at the time when the Chinese are net sellers. The Japanese institutions are backing out, so the foreigners are net sellers of this debt. It's all going to be funded domestically. That is going to be a huge, great problem. The Americans are in a debt trap. Now, at the moment, if we do have the beginning of a collapse in the equity market, then I would expect the Fed to bring forward cuts in interest rates. But what would that do against the situation of spiraling debt? The answer is it would destroy the currency. Get out of credit. Keep on telling you. So there are just a few. I'm sure that if you ask someone else, they might come up with a few more. But I think that's a scare list long enough. Thank you for asking the question, Paul.
Thank you, Alasdair, for your contribution and your insights.